The vast majority of investors are attracted to or entertained by shiny stuff. This stuff doesn't really matter.
Discipline is the one thing that most investors lack.
At very worst, you didn't lose any money. In fact, you came out slightly on top.
But one of the major solar companies in the world has just filed for bankruptcy.
The question is, have fundamentals changed, or is this just a short-term shakeout?
During the course of the next 5-10 years, we're going to have incredible volatility, which we've already warned you about.
All right, let's just jump straight in. It's been a volatile couple of weeks, so we thought we'd put this presentation together to provide a perspective, I guess, from our point of view on what's happened, and we'll go through some charts here, talk about what's happened and what members will no doubt be concerned with in the market. So, to start off with, who wants to go first?
Yeah, I love this. I love this. Are you being entertained, or are you entertained? It was what Maximus was on about in the Gladiator. Anyway, so a lot of this volatility, I think, is really for entertainment purposes only. The question is, have fundamentals changed, or is this just a short-term shakeout due to something like the carry trade, the yen carry trade, etc.? We think it's, that's part of it. Markets got way ahead of themselves, particularly driven by the Mag 7, but the underlying fundamentals really have not changed. And we go back here to what Warren Buffett says. The stock market is a device for transferring money from the impatient to the patient. I mean, those words just echo in my head. Good things take time. It's going to take a lot of time for these things to play out. We're going to talk about now. And so one shouldn't get shaken from the tree as such. In Australia, we have these birds called magpies. Not that bird, but the black and white birds. And they're really attracted to shiny things. Quote here, like a magpie, I am a scavenger of shiny things, fairy tales, dead languages, weird folk beliefs, fascinating religions, and more. I would say the vast majority of investors are attracted to or entertained by shiny stuff, but this stuff doesn't really matter in terms of investing. It's a distraction. The real deal, the stuff that matters, is boring, mundane, and really goes unnoticed. Current point at hand, have underlying fundamentals changed, or is just like a lot of so-called intelligence speak for by analysts and commentators, which really, it's no big deal at all.
I would just add there for anyone going, well, we have magpies in other countries too. They're not the same. These ones, like most Australian animals, will harm you. And you generally don't want to mess with them, especially around nesting season.
Yeah, they attack you. They hit you in the back of the head. So just sort of recap on how we're performing. This is a typical portfolio, the asymmetric strategy and the dividend strategy. This is from really inception. So the blue line is the actual portfolio. The green line is it's a mutual fund, a dimensional fund advisors mutual fund, which is a 60-40 split between equities and bonds. International equities, international bonds, 60-40. I think most folks, one has the opportunity to invest in like a balanced fund, the green line, DFA Global Allocation Fund, which is invest in Favour Sectors and markets, high dividend yielding stocks. We don't touch bonds at this stage. Maybe we'll do sometime in the future, but not at this stage. And we're doing okay, even though there's been a little bit of volatility as of late. It's been nothing really that we haven't witnessed before in the history of the portfolios. So while
the interesting thing here that you'll notice, I think, is if you hadn't turned on your news cycle in the last 2 weeks and you looked at this as a portfolio, you wouldn't think anything of it. We've got pretty much the same sort of volatility as we've had back in November 21, or even April of 23, or certainly 2020 in the lows of March of 2020. And each of those times, if you looked at the fundamentals reassert themselves, and they tend to reassert themselves quite dominantly and strongly. And we don't think that there's anything significantly different this time. If you go to the next slide, what I think is worth doing at this point in time, folks, is to not be like the Magpie and look at the short news flow, news cycle, which I think is largely, it's consequential to some degree, only really if you're a trader. But in terms of, let's take a 40,000 foot view. Let's step all the way back and say, okay, what are the major trends and the major things that are going to actually impact economies and hence our portfolios? It's the things that we've been talking about for years now. And I think it's very important to consider that, and especially with respect to our timeframes, which, as you know, are sort of 3-5+ years out. And I don't mean that insofar as we have to wait for 5 years or something, but those are the trends that are in play. And really, I think we need to, what of those have changed, if anything? During the course of the next 5-10 years, we're going to have incredible volatility, which we've already warned you about. And we're likely to have any number of things come along which create significant pullbacks. Every single bull market has these, and every single bear market has them. So what are these major trends in motion? We've got 6 here that I think are worthy of us stopping, pulling back, and looking at that 40,000 foot view and seeing if these are still in play. What is number one? I think it's the big daddy in the room. It's the elephant in the room, so to speak, and it is this global sovereign debt, which is completely unpayable. We're going to show you exactly what that looks like a few slides on. Another one is, again, part of cycles. So debt goes through cycles, commodity markets go through cycles, human beings go through cycles. Just like we have winter, summer, autumn, and spring, we are simultaneously now in a war cycle. And that has very, very powerful implications. Most importantly, we don't have a war cycle, which is deflationary. That's a very important one. Thirdly, structural supply and demand imbalances in the commodity markets, things we've talked about for bloody yonks now, okay? As a consequence of the whole ESG, this idea that we're going to have renewables saving us and so on and so forth, all of these are now coming under pressure. I just tweeted out the other day, we've got one of the major solar companies in the world has just filed for bankruptcy. Almost daily now, we're seeing the economic impact of this disastrous, retarded policies surrounding quote-unquote renewable energy. And that is important because the capital that got deployed into that space did not get deployed into the commodity markets, which we're invested into. Hence, a significant supply side problem. Right now, everybody's worried about the demand side. We've made this case very strongly for 5+ years now, which is that we're going to have a supply side driven inflation where you can and will have poor economic environment, but at the same time we're going to have higher costs of capital, higher costs of these resources because they haven't been invested into, and the way that the governments are going to solve their problems is going to print money, which we're seeing all of that. We're already, I don't know, first innings is already done, and now we're moving forward in that fashion. So the current sell-off in the markets does not have any impact on that. The fourth topic, and this is a much more structural global trend which has been in play for some time now, is this transition of both capital, political, social, and economic power from the west to east. We're going to show you what that looks like, form of some charts and some economic numbers. And number 5, what we've talked about before, this massive amount of capital which has been pooled into quote unquote passive money pools, your BlackRocks, your Vanguards, and various other investment vehicles. And that passive capital has been deployed largely into the top 10 companies. We've referenced that many times before. And so there's this overinvestment into those particular sectors. And remember, where capital goes in one space, it means it's not being deployed in other space. And that also ties back into this extreme underinvestment into the sectors which we tend to be favorable towards. And lastly, number 6 is the underinvestment to physical assets. Again, what we just referenced.
Check out some charts.
These slides here really represent, I guess, from a macro perspective, the sort of sectors and markets themes we're invested in. So the first one, the top left-hand corner, that's the CRB commodity index relative to the S&P 500. You can see their commodities even more unloved, out of favor even compared to where it was back in the days of the so-called TMT bubble in 2000. So nothing's changed, unloved, unwanted. If we go to the right-hand corner, this is small cap value, the Russell Small Cap Value Index relative to the S&P Growth Index. So small cap value stocks relative to large cap growth stocks, as unloved as they were in 2000, even more unloved than they were, just as much as they were at the height of the coronavirus sell-off. Sort of related to all these is commodity producers. That's the bottom left-hand corner. Commodity producers relative to the S&P 500. So this would be your Freeports, Exxons, and the like. Relative to the S&P 500. There we go, as unloved as they were back in 1999, 2000. And now
that's a long time ago.
It's a long time, and look, that's one thing to be as unloved as they were back then. They've also been in a bear market from a relative perspective since, well, pick whatever, 2010, 2011, 2012. It's 10 years plus. Been a ferociously bear market. So we're investing in these things that are really, really unloved, out of favor. Even though we've done okay in our portfolios, as we've seen, it's only just getting into gear. And we think the next 10 years will sort of replicate what we saw from about 2000 to 2010, 2012. It didn't go in a straight line, and a lot of patience is required. It's all very easy looking back on things and going, oh yeah, well, when you're on the coal face, it's a bit different. Now, a lot of our investments are set outside the US, and particularly in emerging markets. Small caps and emerging markets, that's where the value is. So we take the first one on the top left-hand side. This is the MSCI World relative to the S&P 500. It has buying stocks outside the US is not exactly a popular pastime, and probably just as bad, if not worse, is emerging markets versus the S&P 500. Emerging markets are as unloved relative to the S&P 500 as what they were at the height of the long-term capital crisis of 1998.
I was going to say, folks, this is important because there's a massive arbitrage that we have in front of us. And what I mean by that is, if you look on a global basis for the last 20 at least years, what we've done in the West is we've outsourced production to the East. Okay, so average businesses are now, the production house of the world has already shifted. What the West has left is the financialization, and that financialization is backed by debt. As the two of those collapse, you will have that imbalance will be restored. And if you look at this from the perspective of basically global GDP or certainly purchasing power parity, that chart on the bottom left, it's a little bit old actually, but the numbers are actually a little bit higher. So you've got Chinese GDP, which is actually over 19% now, not 18.5, but it doesn't matter. It's on a relative basis, you can see this divergence between where the actual where things get made, and that's wealth. That's actual wealth. And then if you look on the chart on the right, now this is the financialized world. This is what we're looking at from the perspective of production, GDP, compared to the actual market cap. So the interesting thing to look at here is that China has almost 20% of global GDP. The US has 15%, but if you look at the market cap weighting, China's only got 2.6% and the US is 63%, right? That doesn't make sense, okay? It's basically made up by this financialized world, which is backed by debt. So that's the important thing. When this collapses, and we are already in the beginnings of this collapse mode, it is why they're trying to implement central bank currencies. It is why they're actually taking the world into war, because it's the only methodology that they have left in order to try and retain that level of power. Again, this is not any different to the collapse of the Roman Empire or many of the other empires. We're at this critical point in time where this is what's happening. Our positioning, hence, is in basically what China is buying. There was just the other day, I think it was Magpie was saying, he keeps things very simple, and he said, just buy what China's buying. China's buying gold, buy gold. So to a certain extent, where we're invested, as Brad, you referenced, we're invested largely into markets outside of the US, but very specifically, we're invested into asset classes as well that have that supply-demand imbalance. So if you go to the next chart, Lucas,
Yeah,
got
it
some
backs
more.
up what you're just saying.
Yeah. So if you look here, folks, and again, this shouldn't be any surprise to you. People know this. At the moment, they're forgetting it. Right now, they're forgetting it because they're looking at the markets getting sold off. They're looking at CNBC, or I don't know, I'm not quite sure. There's a lot of noise, and everyone's trying to have their opinion around what's actually happening. And most of them, I think, are missing the large points. And those large points are these big trends that we're talking about. So, again, share of global GDP. You can see in the top left corner there, you've got that red line is manufacturing, world gross output. China is in the red line, and the US is in the yellow line, and the others are the other sort of periphery countries. You've got Japan, Germany, Britain, and so on and so forth. The little chart just next to it is that coinciding there at the end, where you've got China catching up to the top 10 ex-China countries. And of course, pretty much the same thing, which is your BRICS versus G7 on the right. So the BRICS have now already overtaken the G7 countries. Again, coming back to what I just spoke about before, this is important because the BRICS and what they're invested into and what they produce is vastly undervalued relative to the G7. Remember, go back to that previous. There we go. Okay, so China, 19% of global GDP, and it's only 2.6% of market cap weighting. US 15% and 63%. It's the same thing with respect to the G7 countries. So the G7 still have large market caps, where there's a value being attributed to those countries and the various equities and so on and so forth in them. When really we've already outsourced all the production. The entire production house is sitting largely in the East. And guess what? Now these Muppets have decided that they're going to go to war with them. You're going to go to war with your production house? It's insane, but that's what they're doing. They're going after China. They're going after largely these aligning countries, and they have to align in order to just survive, right? Because they don't want to be taken over, either militarily or economically, by the West. And so we're in this conflict zone, and that brings up the other topic, which is war. At the moment, you would think that people would be looking at the fact that we have a conflict between Israel and Iran brewing. The US has just taken 2 battle carriers into the Persian Gulf, British streets on fire, and no one's really pricing war. They're all worried about the unwind of the carry trade. I mean, it's insane. It's like, forget about the short-term noise. These things are much, much bigger as problems to markets than the fact that the Bank of Japan raised by 25 basis points and a bunch of people got caught on the wrong side of the trade and they're unwinding their trade. They'll unwind their trade, that's fine. And governments are going to do what they're always done. They're going to go, oh shit, we don't know what's the policy measures. Well, they're going to have to cut interest rates, and that's just going to send inflation flying.
What has changed fundamentally? And rather than getting all caught up in the short-term noise and all this banter about the Japanese carry trade, or even banter about the US going into recession, stand back and look at the main driving fundamentals, or the fundamental drivers of these themes we're on. Now, one of those themes, the US shale reserves, the US is through more or less 50% of its shale reserves. Top left-hand corner, US shale production sort of looks like it's topping out. Ooh, yeah, okay, fine. But if you look at beneath the scenes, it's only the Permian Basin that has been growing in terms of production. If you look at all the other basins, they haven't. They are well below the previous peaks. You could argue they've sort of been going sideways for the last few years. We think that they're in decline. Now, if you look more closely at what's happening in the Permian, we look at its production, the year-on-year addition to its production, that's declining. So yes, it is growing. The Permian production is growing, but it is growing at a less and less rate over the last few years. In fact, you take out the momentary lapse of reason due to the corona crisis, it actually has peaked in terms of growth and production. It peaked back in 2018, 2019. Ever since then, it's been really struggling to maintain those growth rates. We think that the Permian probably either at or through 50% of its resource utilization. And once you get through 50% of your resource utilization, it's very, very difficult, if not impossible, to grow. So we keep saying to folks to come back. I mean, what has changed fundamentally? Nothing. Now, we didn't highlight here that the fact is that it's only been US shale that has been accounting for the growth in production over the last 10, 15 years in world oil production. So if we get this right, everything else sort of falls in place. This is way, way more important than any decline or in demand as such due to a recession. This is fundamental, and yet no one talks about this. This is a critical thing. Everyone talks about the shiny stuff, the stuff that entertains folks, but it's neither here nor there. The real deal, the things that really matter, very few people talk. One example of fundamentals, we could have talked about the order books for shipping, so on and so forth. We could talk about declining ore grades in copper. Obviously, time doesn't permit that here, but this is just one example. Go back to the fundamentals. What has changed? Nothing.
It seems that people try and use all sorts of data points and news flow to establish the meaning with what's going on, which is primarily a short-term thing. Whereas the problems, the world's changing, and using those, whatever the Fed's doing, or the carry trade, or what was it before? It was Silicon Valley Bank, or it was commercial rates, there's all these sorts of, or swaps. There's all these headlines that surface every so often, that get repeated on, Twitter and social media and the alt media that just get bandied around, and all the experts weigh in, and in a way, it's just a massive distraction. Let's talk about debt. I know you love talking about debt, Chris.
Well, this is the elephant in the room that right now people are not paying any attention to. Okay, you can see from the chart there. Forget about the top two for the minute. World War II was 103%, right? So basically, when we got to COVID, we were at the same debt levels as we were in a wartime. Today, you can see we've gone way past that. We blew through that little boy and just kept going. And we're not yet ostensibly at war, although I would argue that we sort of are to some degree. So this debt is completely unpayable. That's the important thing. We've got 175.3 trillion, which doesn't account for some of the other unfunded liabilities. It's unpayable. It's completely unpayable. That anyone with a math and a brain can figure out. And the question is, how does that get paid? It gets paid either by default or by printing. And if you go back to, say, 2020, what we can see is already that the US dollar relative to hard assets has lost about 20% of its value. So, right now you could look and you could say, maybe the portfolio's down 20% or whatever the case might be. That's a volatility issue. What we're watching, this big trend unfolding, is a destruction of wealth in terms of inflating away the currency. They tend, these over the course of history, what tends to happen is things go kind of slowly and then they go all at once. There's an argument that has been made of, can't the US go to war to protect its currency? Well, certainly that's something that might be tried. But if that's true, it still wouldn't protect. It might protect the US dollar in terms of its trade, where it continues to be dominant currency in trade. But that's unlikely to happen where that currency itself is valued more than underlying hard assets, which Brad, you just made an excellent case for with respect to the supply-demand imbalance. And so your probability of that taking place is extraordinarily low. The only way they're going to pay off this debt is by inflating it away. And if they go to war, wars are financed with debt, and the debt levels will increase. We already have, if you look at that, so this is where the chart on the top right comes in, that white line is your interest bill on the debt. It's screaming higher, absolutely screaming higher. It is now bigger than military expenditure, which is quite something given the US's level of military expenditure. All of this stuff is going to need to be financed. You got to be able to finance the deficit spending, and you got to be able to finance increasing wars. Like I said, they've just sailed 2 battle carriers into the Persian Gulf, and if anybody watched Netanyahu's speech in front of Congress a couple of weeks ago, it was very clear that you will all go to war for us, and that probably includes much of the Western quote-unquote civilized world, at least from Netanyahu's perspective, he's like to call it the civilized world. Bit of an embarrassment, but nevertheless. So we are moving towards some conflict, or at least a probability of that. That always gets financed. It has to be financed. Again, you look at the debts already. So in that environment, if you see that you're moving towards that environment, not owning assets that protect you from that inflationary, or I'd say hyper stagflationary environment, I think is a very, very dangerous position to be in. And this is where we talk about this west to east trend. Okay, you and I don't really matter. What is it that the big players in the world are doing? Well, it's clear what they have been doing for some time. It's not like this came along yesterday and they've decided, oh, we see a problem now. No, ever since 2014, the Chinese have been declining their purchase of treasuries. You can see their treasury holdings there on the left. And guess what they're doing with it? Well, they're buying ports, and they're buying infrastructure, and they're buying gold mines, and they're buying copper mines, and they're putting in railroads in Nicaragua, and they're putting them into hard assets. And all of those hard assets, folks, are almost always tied to things like commodities. It's infrastructure related to transportation, and it's commodities. On the right, you will see our major BRICS trio, the Russia, India, and China, and their official gold reserves. The trend is very, very clear. You front run what these guys are doing. They are the major production house in the world now. They actually have all the real wealth. The fiat wealth remains in the West, in Nvidia, Microsoft, treasury markets, things of that nature. We don't have an inflation because we're living too well. We have it because the government's living too well. Isn't that really just what we've been watching for the last, 10 years? This incredible nonsense. Everybody gets a freebie for this, that, or the other thing. If you could prove that you're a victim of some description, guess what? You get some freebie. And there's nothing free in the world, right? So we have this increasing socialist democratic system that largely the West has, and it's overburdened. There's more and more people looking for handouts. There's less and less actual production. Again, the production's all been offshored. We've squeezed all that we can out of the economic structure, right? You got a business, makes X profits. You go, okay, I'm going to get rid of my staff because they're sitting in Austin or wherever it happens to be, or Berlin, and they're costing me X number of dollars because the government said that I have a minimum wage I've got to pay. I'll just hire a bunch of people in Shanghai or in Vietnam or Yangon or wherever it happens to be, and off you go. So great, now your business is a little bit more profitable. Who's buying it? Well, the people who are buying it, they're all doing it on credit. Who's providing the credit? Well, it's social payouts from the government. This entire thing is so overwhelmingly top heavy that it has to collapse. It has to, and that's what we're positioned for. I think not doing so is, again,
we've talked about this often before. If you invest in stuff that are unloved, out of favor, and has been so for some time, it's difficult to go wrong, or at least not make money on a long enough time view. So we go back here to the TMT bubble, the collapse of the TMT bubble, technology, media, telecommunications, or otherwise called .com bubble, back from March 2000 to March 2003. The S&P went down some 45%, I think it was. The NASDAQ was down about 80% at one stage. That was, I think, in October 2002. But if you invested in a basket of small cap value stocks, they weren't hard to find. This is just the Russell Small Cap Value Index, the white line. At very worst, you didn't lose any money. In fact, you came out slightly on top. It wasn't, of course, it didn't go in a straight line up. It was quite rocky. In fact, you actually made good money. The real problem there came in June, July, August 2002. Anyway, if we go to the next slide, indices, but in the years prior. So in the lead up to the TMT bubble, small cap value stocks had done exceptionally bad. In fact, value stocks full stop had done exceptionally badly. No one was interested in investing in them. It was all the rage back then was technology, telecommunications, and media. And you can see there that the purple line is the NASDAQ. So from the start of 1998 until March 2000, it was up, it's indexed to 100. It was up about 365%. S&P was up about 70 odd percent. I should say 60%, and small cap growth stocks, largely tech stocks, up some 70 odd percent. But small cap value, you'd actually lost in those 2.5 years. You'd lost about 10%. It was incredibly frustrating to see markets going, or the so-called market, the S&P going up, the NASDAQ going up, and the value stocks one invested in doing very, very poorly. But 3 years out, even with the S&P going down some 50 odd percent, you hadn't lost any money. And that's what we want to try and point out. Not that we necessarily think the S&P is going into a bear market, who knows, but we're very, very confident in that even if we do see substantial downside in the S&P, it's the downside we're likely to see in our portfolios is going to be very, very limited. And so this is why we're quite comfortable in what we're doing. We're not worried, we're not stressed, we sleep well at night. We're invested in things that are favor and invested in things that are very, very cheap, where the long-term fundamentals are very, very favorable for these investments.
It's sort of easy to say that now that you've had decades of dealing with this sort of stuff. But let's bring it back to people or members of Insider, for example, who are perhaps newer to the service and haven't experienced things like this before. I think the next slide, Chris, if you want to go through it and maybe not allay people's fears, but just explain that it's completely normal. The emotional reaction to what's happened is, for some people, it should be normalized, like it's normal to feel that way. If you've not experienced it before and you perhaps are newer and have never had something like this happen.
I think it's important to understand, and we've mentioned this many times, we are going to get volatility. As you move through these cycles, the volatility will actually increase. And you need to decide how you're going to play that. And we've said this many times before. You need to decide whether you're a trader and you have the ability to trade it. If you're sitting there now and you haven't traded it, then the answer is you're not a trader already. What you don't want to be is someone who goes from being an investor to suddenly deciding that you're going to be a trader, because those are the very same people who start out as who will decide they're traders, and then they'll find that they're actually bad at trading. And then we'll say, oh, I'm an investor, right? It's the guy who buys something or sells something as a trader and then waits and oh no, it doesn't come back to me. And then they'll end up buying in at the top, right? And then it'll come down and they'll, oh, well, I'm not a trader. I'm going to hold this. This is my investment. And I've seen that many, many times before. Decide what you are. We're investors. We're long-term investors. We're looking at the structural trends in motion. We're looking at the big elephant in the room, and we're playing that game. We're not getting into the trading game. It's not worthwhile. Doesn't benefit us in any shape or form. When things like this transpire, you need to simply go back and have a look at those major things in motion. Are they still in motion? If the answer is yes, okay, fine. You might get something wrong. If you're wrong, that's fine. You look at it and you say, okay, I need to address that. I got this wrong. What do I do? So let's look at the main big picture. Again, we're positioning for where things are likely to be based on those topics we covered in the earlier slide, many years out, 3-5 years out. These are themes and sectors which are out of favor, structural imbalances in terms of supply and demand. We've got the long-term fundamentals that are in our favor. The valuations of these particular companies are low. We have this global debt problem, which we've mentioned. It's unpayable. The next decade or so is going to be absolutely dominated by that big trade. Historically, that means physical stuff will outperform paper, fiat. And on top of it, now we have this war cycle and a global and domestic conflicts, which are now here and accelerating. I mean, again, I just forget about this unwind of the carry trade right now. Have a look at what's going on in Leeds, in London, in Manchester, Okay, domestic conflict. Have a look at what's happening in the Middle East. We've just had Egypt come out saying that they're not going to allow the US to utilize their bases for any military conflict against Israel. We've had Israel coming out, they're going to, they already bombed Palestine or took military action inside the borders of Palestine. We've had the Iranians say that they're going to retaliate. We've had the Russians say that they're going to back the Iranians, and we've got the Chinese calling on the end of the United Nations, saying that they're a genocidal group of nutcase jobs. So you have this confluence of varying sides building up towards a conflict. In that environment, you absolutely have to be, in my book, invested into asset classes that are going to at least retain your purchasing power in that. So that's one thing. And then the last point is just, does this happen tomorrow? I don't know. I don't really care. It's inevitable. And so you play for the inevitable. And how do you deal with the volatility? You need to decide how you're going to deal with that yourself. You have to be a big boy, basically. And if you are in a position where you're going, oh my God, I've got to sell all of this. Well, guess what? Maybe you have too much emotionally attached. Maybe you have 100% of your capital in this. I don't really know. For Brad, you and I, we can have pretty much 100% of our capital. We've been through this for, we're professionals, so we have a different outlook on things. If you're in a position where you're finding that that's very problematic for you, you can reduce your position sizing such that you can handle that volatility, and be patient. We had, was it March 2020, we had a similar discussions with clients. We had some clients pulling their money and then literally coming back to us a year later going, damn, I wish I hadn't done that. Can I come back in? And they just lost out on 50-60% returns. I don't know for sure that this is going to transpire in the same way, but I do know that all of these major trends are in motion, and we do believe that this is the best way for us to protect our capital and to position ourselves for these major trends unfolding. Buffett, I think, has some more words of wisdom, which is we don't have to be smarter than the rest, and certainly we're not. We just have to be more disciplined than the rest, and I think that's absolutely true. Discipline is the one thing that I think most investors lack the most of. It's not about being smart. It's about continuously reassessing what you have and being disciplined about things. That's our current viewpoint, folks. We welcome any questions you might have around it, and certainly the environment that we're in isn't going to go away. We're going to continue to have high volatility. We're likely to have all sorts of crazy shit going on, and you should always look back and say, okay, how to prepare yourself for that now. Prepare yourself mentally for those things to come, and say, what should you be invested in? What makes logical sense? And how are you going to treat it when the asset classes that you invest into rise by 20-30% or fall by 20-30%? Because you're going to get both.